leading indicators have declined 14 months in a row. Now, I remember in the day when this measure of leading indicators was down for 3 consecutive months, the conclusion most economists would draw is that the economy is going into a recession. Well, now we're 14 months into it. And we do believe we'll see a recession, a little bit of a harder landing, as I've mentioned on many of these. M2 down 5% on a year-over-year basis. Haven't seen that since the 1930s. And we do think velocity is starting to slow down. The velocity of money, the rate at which money turns over, because of the regional bank crisis and the concerns, wait, what's going on here?
The global financial geopolitical landscape may witness a significant transformation as BRICS, a prominent economic coalition consisting of Brazil, Russia, India, China, and South Africa, considers the possibility of a common currency. Though the idea appears audacious, the final decision is still pending. Recent developments indicate that BRICS nations are moving towards de-dollarization, reducing their reliance on the US dollar. But instead of converging on a shared currency, they are gradually shifting towards conducting transactions in their respective national currencies. While a common currency could potentially reshape international trade dynamics, the transition may not be as imminent as some speculations suggest. The new development bank, established by BRICS, has dispelled rumors of an immediate move towards a common currency. Meanwhile, Cathie Wood discusses various economic indicators signaling the global economic landscape's shift and highlights Bitcoin as a hedge against inflation. It's worth noting that the shift towards a common currency remains uncertain, but the BRICS nations are actively exploring options to reduce dependence on the US dollar, which could have implications for the global financial order in the future. Cathie Wood also emphasizes the importance of monitoring market signals and considers Bitcoin as a potential hedge in times of inflation.
Please take a moment to like this video, subscribe to the channel, and don't forget to drop your comment and observations in the comment section below. Thanks and enjoy the video.
I wanted to feature some of the stronger than expected before we go into weaker than expected. Housing and autos, interestingly, delivered some surprisingly strong statistics. We see pending home sales down 21% on a year-over-year basis. That sounds very weak, and it is. But one of the reasons is people are trapped in their existing homes by their current mortgage rates, which are very low compared to today's. And so we're seeing new home sales is where a lot of action is taking place. New home sales were up 12% month to month in the month of May, I believe that was. And housing starts were up to 1.6 million from 1.34 the previous month. That's an annualized number. So the new home sales are where a lot of the action seems to be going these days. Autos came in a little higher than we expected. Last month was 15 million units at an annual rate. This month was 15.68 million units at an annual rate. What we see going on in the auto sector, this dramatic shift towards electric vehicles, we believe is starting to put pressure on the auto manufacturers. They've reintroduced discounts. Remember, they were selling at premiums before. Reintroduced discounts. And we think they're trying to move their inventory as this consumer preference shift towards electric gathers momentum. So that could be one reason for this. The other variable that was on the stronger side was durable goods orders. Non-defense capital goods orders, ex-aircraft, is a very good indication of capital spending, and we do think two things are going on there. One is the excitement around artificial intelligence has captured consumers and businesses' imaginations, but there's also an imperative here. If your competition embraces this new technology, which can help you increase productivity and decrease costs, you're going to be in trouble. So a little bit of a land rush there. And also there is the reshoring especially from China, taking place here in the United States. So those are two of those reasons. And and those are strong. But back to the leading indicators. The leading indicators are made up of 12 sub-indicators. So they are average workweek claims, new orders for manufacturing, ISM new orders, building permits, the S&P 500, the credit index, the yield curve, and consumer expectations as measured by the Conference Board. Now, those have all been negative for 15 months. And as I mentioned, if we don't head into recession, meaning declining activity, it will be quite a big setback for this measure of leading indicators, and may suggest that it is too much focused on the industrial world and not enough focused on the digital world. That could be the case. Nonetheless, they are negative, and a lot of the regression analyses that I see from economists are pointing towards negative GDP sometime in the second half of this year and into, and some are saying through, 2024. And this will get the Fed to change its spots. And the market, which had taken such a serious tumble last year, had seen this, we believe, and has discounted a lot of this. Maybe not all. There are some investors I know, moving back into more value-oriented strategies, which are more hostage to the cycle, figuring, we're going to skip a recession. I don't think that's going to be the case. I think that companies that are comfortable, have secular growth opportunities, that are recession resistant, they won't escape a recession entirely, but recession resistant, that they will continue to be rewarded.
This year has brought some significant surprises in the real estate market. Initially, the expectation was for a continuation of slow demand and rising inventory, extending the trends seen in 2022. However, demand stabilized, and the supply of new homes became even scarcer, leading to a decline in inventory and stable home prices. Nonetheless, the recent climb in mortgage rates has raised concerns among consumers regarding affordability challenges. The key question now is what will drive inventory growth in the second half of the year? If mortgage rates continue to climb, it could dampen demand, resulting in a buildup of inventory similar to what was observed in September and October of the previous year. Conversely, if mortgage rates remain below 7% or decrease further, it could increase homebuyer demand, causing available inventory to shrink further and providing stronger support for home prices in 2023. It's crucial to pay attention to these trends, as conventional wisdom suggests that lower mortgage rates will lead to increased inventory. However, data indicates that lower mortgage rates actually decrease inventory. Cathie Wood's insights on market signals could provide valuable perspectives on the ongoing real estate dynamics. Let's explore her views in the videos we watch.
There are investors out there who do not religiously depend on the broad-based indices, but are doing their homework and are saying and asking the question, who is really going to benefit from this massive shift towards artificial intelligence, which is gaining so much momentum because AI training costs are dropping 70% per year. And they're coming up with good answers, we would say. This is what we do all the time, and it's nice to have the company again, if I might say. Long-term interest rates, they moved up from 364 today, 405. Interesting, we're getting a good test here. In March, the 10-year Treasury bond yield peaked around 4.8 to 410. Today it's 405. In October before that, it had a peak at 4.3. So lower highs, we are having a little bit of a test here. And we'd be surprised to see long rates continue to move out because of the weakness that we see evolving in the economy. And because inflation's coming down. And because it could be negative, which I think would shock a lot of people. I was around, did a roadshow in Europe last week, and I asked the question, how many of you here are hearing forecasters talk about deflation? Nobody. Maybe one hand went up and I said, I think you heard us talking about that. So no one's talking about it, and our confidence is increasing that it will happen, that it won't be all bad. Innovation is deflationary. I just told you AI training costs are dropping 70% per year. That's going to seep into many, many other costs and cause unit growth to accelerate. The Bloomberg Commodity Price Index, it moved up 3% in the month of June, but is still in a downtrend. Should have mentioned the yield curve is still inverted. It got more inverted last month. It got to almost 110 basis points, which is the inversion it reached right before the regional bank crisis. It's come off that a bit here, but we wouldn't be surprised to see if it signaling, more crises, whether they're in the commercial real estate market or in the private equity market in a way that we don't understand right now. Bitcoin, sort of the harbinger for crypto, up 10%, good month. And of course, there is the speculation about a potential approval of a Bitcoin ETF. That got people excited. But the other thing we'd like to reiterate is we saw Bitcoin take off from 19,000 to 30,000 when the regional bank crisis was in full force in March, April. And that told us that Bitcoin is a flight to safety currency. It's a hedge against inflation. It's a hedge against deflation. Deflation presents counterparty risks that do not exist in the world of Bitcoin. And we think innovation broadly is going to become a flight to safety category.
The cryptocurrency market has witnessed some significant shifts this year. While Bitcoin hovers around $30,000, other cryptocurrencies trade with cautious optimism. Notably, multiple applications have been filed with the Securities and Exchange Commission to launch spot Bitcoin exchange-traded funds. What sets these applications apart is the involvement of major financial firms like BlackRock and Fidelity, signaling a potential change in the crypto landscape. The crypto sector's future seems to be driven by the participation of traditional financial players rather than the crypto-native sector. As ETFs gain approval and attract capital, trading fees and commissions may decrease, fostering more automation and AI-based trading. However, this development may also impact Bitcoin's use as a currency, as its appeal as an asset class grows, making it more attractive for long-term investments rather than daily transactions. Cathie Wood's insights provide valuable signals and indicators for the future of the crypto market. As these changes unfold, market participants must remain vigilant and consider how these developments could reshape the crypto landscape. Share your thoughts on these developments and Cathie Wood's observations in the comments below. For more Daily Dose Crypto news, check out these two awesome videos on your screen. Click now and we will see you on the next video.